All right, welcome back to the New Equity Network Show. I'm Michael Yorba, your host. Thanks for listening to us on 1160 AM KBCE, Dallas's Business Authority. All right, I'm joined in studio with Michael Hanberry, president of BTJ Consulting, truly the investor's advocate in the oil and gas industry. And Michael, we spoke on the last segment about the things, the red flags that you look for that you don't want to be involved with, you don't want your clients involved with. Let's talk about the other side, the positive side of the types of deals that are coming to you now, why you're enthused with them, and what are the telltale signals of the things that tell you this is a deal I want to participate with right alongside with my clients.
Well, it has to be a deal that obviously makes sense, return on investment. We don't need pie in the sky. What we need is to be involved in a field that's got steady production surrounding us, that has high structure that's been left behind, that's still there to be drilled out. We can clearly see on the topographical maps if they redo the geophysical work on an old oil field. If you're going to get back into an oil field that originally was drilled without any seismic, they'll just checkerboard those fields where they can get leases. And then in a lot of cases never go back to them, or they'll hit wells that, for instance, where they hit gas, and the gas is still there, but gas wasn't worth anything back in the day. There wasn't any transportation or midstream pipeline to get the gas to market, and if you put a tank down and compress it, it's $1 million. So they would walk away from that gas. Or there's oil that, say, they couldn't get it to flow on its own, and they didn't want to put a pump jack on it. Might be at $2 a barrel. Not commercial for a major that came through that field back in the day, but these are generally shallow wells, so they're 100, 150, 175 bucks a foot, depending on what you're drilling through. I mean,
when you say 150, 175 dollars a foot, you're talking about the cost to drill, right?
Right, and so it's inexpensive, which was what you need. You need an economical drill at this juncture because you've got $50 oil, so. You can't go out there and do a lot of drilling in the shale, or unless you're a big boy and you've got the budget for it right now, because it's you got to have $70, $80 oil to make that commercially profitable. So we look for things that are commercially viable right now in this market, that are in field, surrounded by production, with multiple stacked pay zones, which means it's kind of like a layer cake. You don't just have one bite at the apple. Generally, there may be 10 or 11 different zones, not all of which will pay every time. But you know what that mud makeup is when you drill through it, and the mud loggers will look at that mud and analyze it and be able to tell you, well, you've got 50 foot of, the Viola or the Wilcox or whatever particular formation that you're drilling through, and they know that formation by its mud makeup. So we're looking for, 2 or 3 of those 11 zones to work for us that traditionally will and have worked all around you 360 degrees. So that you don't have just one bite at the apple, that you're already in a known proven oil field surrounded by production and looking for the high structures or the trapping areas that they left behind, or gas, or, slower paying oil wells that weren't commercial for them.
Okay. Now, without getting into particulars, the deals that come across your desk, I mean, because, sometimes you've got smaller projects and sometimes you have bigger projects. Can you give us a range of what you're looking at that's coming to the forefront now? Because we've been holding here from $40 to $60 a barrel here for several months, and that's bringing a lot of stuff out of the woodwork here. So what kind of deals are flowing across your desk, if I may ask, and don't get yourself in trouble by answering the wrong question, though?
No, they range from $1 million to $3 million. What we don't want, and the reason we like crowdfunding, corporate crowdfunding, and then the other funding,
energyfunders.com.
Energy funders, is because I can take $1 million project and move it very quickly to my own clients.
Right.
But if I've got a $3 million project, what we don't want to do is have anybody's money sitting around not earning money for very long.
Right.
So what they've done as a disruptor in our business is stop that 2 or 3 month raise. Because they can get in there, we can attack that amount of money very quickly from 3 different angles, and everybody's happy. All of a sudden, we've got a bit in the ground.
Right. Okay. Let's talk about the future of this industry sector. Do you see oil stabilized at this area? Do you see it gradually moving up? Because I think one time you had mentioned, T. Boone Pickens was talking about crude going back to $100 a barrel, and I think we had some Saudi king or prince say, hey, $200 a barrel. What's the real the real outlet from somebody who's in the business who's got to depend on these prices to make a living?
Well, I think you're going to see oil go to 100, and I think the Saudi king probably is right. I just don't think it's going to be any time like tomorrow,
right?
That you'll see 200 one day. I mean, it's a depleted. Every day there's more people using it, and every day we have less on the planet than we had yesterday. So it is not going to be here forever, and so the price is going to go up eventually. More people on the third world countries that are now becoming manufacturing powerhouses that need more energy. I mean, we're spinning it faster and faster and faster every day, and there's eventually we're going to run out of this resource. So it's going to go up. I don't think it's going to be tomorrow. I think $70, $80 oil is where it needs to be. Are we going to see 100 in the next 12, 18 months? More than likely, but it's anybody's best guess. These people don't play by the rules who set these prices. They say it's supply demand, and I know the theory, when they're not going along by that. They just don't follow those rules. I mean, somebody gets in another war over in the Middle East, and all of a sudden the price goes through the roof. And then somebody gets in another war in the Middle East, and the price is down, and the price doesn't go through the roof. So, I mean, is it because somebody got in the war in the Middle East? No. So don't say it is next time. So all I can tell you is what I know, and their greed will take over. It's going back to probably stabilize in 70, 80. You're going to see 100 again sometime. But 70, 80 is a good price. We all make plenty of money. Nobody gets filthy, stupid rich. And that's a reasonable rate. And gas isn't over the top at the pump. And I think everybody would be happy if they'd leave it there, but they won't.
Okay, well, they probably won't. Let me get back into BTJ's portfolio for a minute, because many times when people get calls from, let's say, salesmen who are looking to raise money for a project, they've got one project that they're working on right this minute, but you've got a different approach because you actually have a portfolio of a variety of projects. Is that right?
Right. We try to take and figure out what their favorite color is. What's your flavor? What are you trying to do? You're trying to create wealth right now. I've got wealth creation programs for you that are a little bit higher risk, but much higher return. Are you looking for wealth preservation projects? Do you want to buy royalties or overriding royalty interests? Those are very, very stable on the lines of a municipality would purchase them. A Fortune 500 CFO would purchase them for their 401ks. These are, guys that have family trust, legacy money. They'll put tens of millions of dollars in royalties, for instance, because it is that stable on more along the lines of an annuity. But it doesn't start sexy. It may start at 4, 7, 10%, and then, but it's kind of like an X. If you draw an X on a piece of paper, your sexy, riskier deal, although we're not going to be wildcat and I won't let you do it if you're talking to me, but you start at the top left of that X and you come down across to the bottom right, because eventually it's going to slow down. They'll do your depletion over time. You have a curve, probably 50%, and it'll slow down and run, say, 40% annual return instead of 80 the second year, and then it comes down to 20%. And eventually it'll be on a pump jack doing 2 or 3 or 4 or 5 barrel a day. But you got your money back pretty quick in your pocket, and that's exciting, and everybody likes that. And you get the IDCs, which is 100% tax-deductible investment. The other side of that, go to the other side of the X on the bottom left and come up to the right. Now, like a slow freight train coming out of the station, it's going to eventually, you might have a 100-well project. You're making 10% return on 12 wells. You're contracted to drill another 17 with room for 70 more after that. And it's stable and it's steady, and you've got a major publicly traded billion-dollar company that's doing the operating. That's as stable as it gets in this business. And eventually, you're making the oil goes to 100, and you've gone from a 20 to a 40% annual return with no cash calls, with no drilling risk, with no surface liabilities. That's a real stable way to put the opposite end of the spectrum. So we look at it all.
Okay, so actually, what we're talking about is a portfolio that's got both high risk, high return, and where people are looking for a bigger return up front, and then also
the tax deductions.
And the tax deductions, and then the freight train on the other side with these royalty projects.
Starts out slow. You don't get IDCs, and it's a 15% tax-free money on that. They only tax 85% of the dollar for depletion allowance on the royalties, but it is the most stable way to be in the business is to actually own the mineral rights.
All right, we've got to go. Thanks for being in on the show with me today, Michael. I appreciate it.
It was a pleasure, Mike. I appreciate the time.
All right, Michael Hanberry, BTJ Consulting. You've been listening to the New Equity Network show with Michael Yorba, your host. Thanks for joining.